Sometimes it can feel like no matter what you do, you can follow your rules, execute your system perfectly, and still feel like you're not actually getting anywhere as a trader. But what I realized was it wasn't the strategy that was going to make me profitable. Most of the information online wasn't actually benefiting me. It wasn't actually what was going to get me to where I needed to be. To become profitable, I had to follow a system, and not just any system, a system that worked for me, something that I was able to implement over and over and over again. That's why I wanted to make this video, to cover everything and give the answers to all the questions that I had back when I was asking them and I couldn't find any answers. There are three main components when it comes to trading. You have your psychology, you have your risk management, and then you also have your strategy. Not one of these things alone is going to make you profitable. That's why you feel like your strategy doesn't work and your strategy is not making you profitable, because it's a combination of all of these three things that helps you build an edge to allow you to become a profitable trader. So this is what I wanted to break down and cover everything. So if you never watch another trading video again, at least you've watched this and I can give you all of the information that you need to move forward and build a system that actually works for you. So this is the framework. So building an edge, it's a combination of psychology, strategy, and risk management. And why is that important? Risk management, where are you wrong? Where does your stop loss need to go? Not where you feel like you can handle a loss, but where logically does the stop loss need to go? How much are you willing to risk on that trade? I'm willing to risk X amount to make X amount. And can you achieve the correct R to R? So there's no point risking 3 times the amount just to try to get a little bit of a win. So 80 to 95% of traders fail prop firm challenges. 40 to 55% of failures come from daily loss limit breaches. So this isn't working on risk management here. This is just letting your losses get too big and blowing that account. 5 to 10% of traders pass the evaluation, and then only 7% of traders ever receive a payout from that total amount. So here's a little tip for you. Traders who use 2% risk and under improve their success rate by 40%. So you're scaling back, but you're trading 40% better. There's no prizes for trying to hit home runs every single time. It's not about that. It's about base hits. It's about staying alive long enough for your edge to play out. This here is probably the biggest one that every single trader struggles with: psychology. Because at the end of the day, every single strategy works. It just depends on whether or not you can implement that strategy or not. So overall, most traders, they're not failing because they can't read price action. You're failing because you can't control your emotions. So when you enter into a trade, you get in your own way. You close early because you're scared that price is going to turn around. You need to secure profits, or you're in a little bit of drawdown, you can't handle it, so you close the trade early and then it goes back in your direction because you're getting in your own way every single time. The reason why we do this is because we feel losses twice as much as we feel the win, and this is what leads to what we call loss aversion. So when we're trying to avoid losses, we're actually incurring more losses. So instead of following a structured plan, we're in and out, we're erratic, we're FOMO trading, we're revenge trading, we're doing all of these things that we shouldn't be doing. So instead of trading, we're becoming gamblers. And trading isn't about gambling. Trading is about calculated risk, following an edge and a system to allow probabilities to play out over time. As we look down here, we got our strategy and our technical analysis. So strategy, technical analysis, being able to identify trends, reading market structure, identifying what your A+ setup looks like. And again here, risk management. Can you achieve the right RR on this trade, or are you just gambling? And this is one of the biggest issues that we face as traders, is most of the time it isn't a skill issue that we're struggling with, it's a capital issue. Because if you're going into the market with $100 to trade with, your risk is going to be $1 to make $2, and it's not going to feel like you're getting very far. So this is why most of the time, it's not that you're a bad trader, it's just a capital issue that you just need to work on. It's just about getting more capital. And this is the biggest issue as well with traders, is they fall into thinking that they need to learn more about technical analysis to trade better. Most of the time, within the first few months of trading, you already know pretty much enough there is to know about trading. If you can understand liquidity, trend direction, market structure, price action, you know enough to trade. The more you learn, it's not going to make you a better trader. It's going to make it harder for you to trade, because you're going to have analysis paralysis and you're not going to be able to enter or exit positions because you're just going to be overloaded with information. You're going to start getting confused and you're going to not be sure what to do, because one strategy said to do this and now the next strategy is telling you to do something else, and now you're not sure whether or not you should enter or exit into that position. And so this is it. Once you've learned your system, it's not about learning more about the markets, it's about mastering yourself. yourself, because psychology plus strategy plus risk management equals your edge. It's not any of these things alone, it's all three together, which is what makes up your edge. Break down each part, starting with psychology. I love psychology because I feel like it is one of the most important aspects. They're all equally as important, but psychology is the hardest part because everything stems from this. If you're having trouble with your strategy, it's because of your psychology. If you're having trouble with your risk management, it's because of your psychology. Because you will feel fear, you will feel greed, you'll want to revenge trade because that's normal. The goal is not to eliminate these feelings. We're not robots. You're never going to get rid of your emotions. The goal is to set systems so clear and rules so defined that you execute correctly anyway. Discipline is not a personality trait, it's a system design problem. Build the right system and discipline becomes the easy choice. So it's just about repetition. It's just about building that confidence in yourself, getting enough reps in, doing the system enough so that you feel confident and you trust yourself and you also trust your system. Because trading psychology is not about being emotionless. It's about being able to execute your plan consistently regardless of how you feel in the moment. We try to think that we can eliminate emotions and become a robot and not feel anything, but this isn't the case. You're not a robot, you're a human being. You need to know how to react in the situation when you are feeling like this, and just understand that the market's a game of probabilities. Whatever happens, happens. You have no control over it. And this is where we get trapped, because every trader is doing everything they can to avoid losses. Like I mentioned before, we search for countless hours to find the system that will give a 99% win rate. This is why we see so much of this stuff online about high win rates and never losing and all this kind of stuff, because we're trying to avoid losses. We don't want that pain. We want to be winners. But the hard truth is, this is what's causing you to lose big. And this is why losses hurt twice as much as a win feels good. And if you ever notice this, you might be up in a trade $500 and you're kind of like, it's okay, it doesn't feel that good. But $500 of drawdown and you start to go manic. It feels horrible, right? It feels terrible. And this is a good book here if you want to learn a little bit more about that feeling. So if you ever feel like your mind is being hijacked and all of a sudden you can't control yourself in the moment, and then it passes and you're sitting there thinking, what's just happened? Why did I do this? Why has this happened to me? This book here called The Chimp Paradox. It's not a trading book exactly, but it's a great book that really breaks down that feeling of where, your mind's just been hijacked by something and you're sort of left thinking, what's just happened? Why have I done this? So this is sort of the system for trading psychology. So trading psychology is not about being emotionless. It's about executing your plan regardless of how you feel in the moment. Whether you're scared or whether you feel unsure, or like me, I used to feel a lot of analysis paralysis and I used to second guess and I could never enter. This is what it is about. It's not about how you feel. It's about what your system is telling you that you need to do. And then this is where it leads to loss aversion, because like I said, we're feeling those losses twice as much as we feel a win. It's just hardwired into our brain. Like, it's not a weakness. We can't get rid of it. It's just psychologically hardwired. And this is what it causes us to try and avoid losses. So cutting winners early and revenge trading. But this is what it feeds into. It feeds into fear. We're not going to take a valid setup because we're trying to avoid losses. We want certainty. We want guarantees. We want to know that this trade is 100% going to play out in our favor. And that's all we are trying to do. And then this is when the greed comes in, because we also want to win. We want more than what we get. So, I only want $1,000. And once I get $1,000, I'm going to be happy. And then you get that $1,000 and now you want $2,000. And then when you get $2,000, you're going to be happy. But when you get 2,000, now you want 3,000. So we just get greedy. And this is when we hold trades past when we should. So have you ever noticed that when you pull your take profit too high, price will come up and then it will come straight back down. You go, I wish I took profits when I was supposed to, because we got a little bit of greedy. And then it leads into FOMO. So we're chasing missed trades. So we have the perfect opportunity. Instead of executing, we let it move away, and then we feel like we're going to miss out. So we jump in the trade. We can't manage risk correctly because we can't put our stop loss where it's supposed to go. And then price comes down, retraces, hits your stop loss, and then you have a loss. And then it leads to this, revenge. So just like this, as soon as you've had that loss, what do you want to do? You want to prove the market wrong. You want to prove the market that you're better than it. You want to make your money back, and you are going to go in and revenge trade until you've proved that point and made that money. But it's just going to cause more losses. And then these are the other two. These are probably the most dangerous. So overconfidence in sizing up after a win, or increasing leverage, right? You've just had a great win. So what do you feel like you can do? You feel like you can go bigger because you've made money and that you can handle this and this is fine. Or you're feeling overconfident and you're feeling like the market can't beat you. I'm just going to take whatever trades because I'm on a 3 trade winning streak. I'm unstoppable. And these are the pitfalls that go through your mind that are getting in your way, that are causing you to lose trades. And these are the causes of all of this, because most psychology problems are process problems. So you're not trusting yourself. You don't trust your system. You're blaming the markets. You're thinking like a casino. You're not a gambler. We're traders. And you need to detach from the outcomes of trade. So every trader, all we're focused on is that one single outcome. That's all we're worried about. It's not about looking at trades in batches. We see one loss and we think, oh, this strategy doesn't work, or we get maybe, 3 or 4 losses, and then we think, oh, the strategy doesn't work because I've had a series of losses. But this is just probability. You need to see how profitable your system is over a batch of 50 to 100 trades. You can't tell whether a system's profitable over 1 to 5 trades. It's just not enough data. And this is the process. This is the loop we get stuck in, because we think that after 3 or 4 trades, if we haven't become profitable, if we've lost money, then the system doesn't work. And this is why it's important to remember that it's process over outcome. So amateurs base how well they can trade off one single outcome, and then that's how they let it define them. They decide, oh, I've had a loss, so I'm not a good trader. Oh, I've had a 1 win, I'm the best trader out there. But the professional traders, the profitable traders, they're focusing on how well they can execute their system. They aren't worried if their system wins or losses, as long as they've followed their rules, because that's all that actually matters at the end of the day. It's not about the outcome. It's about following everything exactly how you're supposed to. So how do you build a profitable mindset? Because it's a lot easier said than done, right? So it's not like you're going to wake up tomorrow and you're going to become a profitable trader with the trading mindset of, I don't care about losses, I've overcome everything, I don't care about it anymore. It is a process and it does take time, but it's all about repetition and consistency, so then that way you can keep moving forward rather than going around and around in a circle. And one of the main important things is just accepting that losses are a part of business. Losses are inevitable. You're never going to get away from losses. It's impossible. And the more that you are trying to avoid losses, the more losses that you are going to have, and the more they are going to hurt, because you are going to take them very, very personal. But trading isn't personal. It's probability. The markets aren't out to get you. You are the one that's out to get yourself. And detaching from the outcome of individual trades. So like I just mentioned before, one trade doesn't define whether or not you can trade. Just because you've had one winning trade doesn't make you profitable, and one losing trade doesn't make you unprofitable. The outcome of every trade is random. Just because you've had one losing trade doesn't mean that the next trade that you're going to have is going to be a winner or a loser, regardless of the previous result. So if you've just come off a winning trade, you're going to feel great. You're going to feel like you're the best trader on earth. If you've just come off a losing trade, you're going to feel like the worst trader there is, and then you're going to be either extra greedy or very fearful of your next trade based off the previous trade that you've just taken. But no trade you've just taken has anything to do with the next trade you're about to take, because it is probabilities and random. You need to define success as following your rules. It's not about having high win rates. It's not about doing this. It's just about following a system and following those rules. And that is what's successful, because the outcome is irrelevant. You can follow your rules perfectly and still have a losing trade. That does not mean that that was a bad trade. That means that you did everything right. That is a good trade, regardless of the outcome. A bad trade is if you don't follow your rules and the trade goes to take profit, because that is just setting bad habits. And we don't need bad habits. We need to set good habits and follow a structured system. You need to build confidence through data, not hope. So a lot of traders, they'll enter into the market and they'll, hope trading's just going to work out and click buy or sell wherever on the charts and just hope for the best. But trading isn't about that. Trading is about building confidence in yourself and in your system, because if you aren't confident in your system, when it comes time to execute, you will be like me, like I used to be, too scared to enter and watch the market go without me, and then FOMO in later and then get my stop loss hit, because I didn't have the confidence, because I hadn't collected enough data. I didn't have 100 trades. I had a couple of trades, and that's what I based everything off. I thought, okay, cool, I've got a couple of trades. Whether or not this is profitable, it wasn't about data. It was literally all I was running on was hope and dreams, and it didn't really get me very far. And this is another important one as well. You need to stop chasing certainty. The market is never going to give you certainty. One of the most important things that you can do is accept this. Accept that nothing is guaranteed. Doesn't matter if you do everything right, you can still lose that next trade, because that uncertainty and that searching for certainty is what's making you add more indicators, try to do more research, add more confluence, and trying to do that loss aversion and trying to protect yourself. Thinking in probabilities, not predictions. Everyone out there is saying that they can predict the future, that they've got a crystal ball, they're the best trader ever, they know exactly which way the market's going. No one knows which way the market's going. Nobody knows, nobody has a crystal ball. All you need to do is think in probabilities, because even your best setups, they will fail. But when you think in probabilities, you stop being surprised by your losses and you stop being overconfident after wins. Every outcome is just one data point in this big 100 trades. That's all it is. One variable. And removing ego from every decision. So the ego wants to be right. You don't want to be wrong. As humans, we love being right. We love winning. It feels good. It's euphoric, but it doesn't help you because ego will make you skip a valid setup because you don't have the confidence to then take that setup because you don't want to be wrong. And the profitable mindset has no attachment to being right. The only attachment is to following the process. That is it. The outcome, like I said, is irrelevant. It's just one data point in a larger sample of trades, that 100 trades, that large batch to see whether or not your edge is working. And the last one, which is the identity shift. The identity shift is someone who isn't trying to make money. So a lot of traders, we start coming into the markets and we're looking at making money. That's the only thing we're focused on is how much money can we make. But all you need to be doing is to start identifying as someone who executes a process. That is it. The profitable trader doesn't go into the markets thinking, how much money can I make? The profitable trader goes into the market thinking, how much capital can I protect? And do I have an A+ setup that I can follow and execute my system? Because that's all I'm here to do, is I'm here to follow my process and the money will come from doing this. Because the profitable mindset is not built in a day. It is a trade by trade, journal entry by journal entry, until following the rules becomes who you are. And it will take time, but if you try to build a trading mindset and focus on the things that actually matter, the process of becoming profitable doesn't even have to be as long as what it does. It doesn't have to take years and years and years. You just need to follow the things that actually matter. So then that way you're not chasing your tail going around and around over things that don't matter, like high win rates and all this flashy stuff, right? So moving on, risk management. So why is risk management so important? Because the only things that you can control in trading is when you enter, when you exit, how much money you're willing to lose, and the amount of leverage you use. Everything else is probabilities. You can't control it. And this is where your risk management comes in, because the reason you keep blowing your accounts is bad risk management. When I first came into the markets, I thought trading was about making money fast, and I was very, very wrong. Trading is about protecting capital and managing risk long enough to stay alive for your edge to play out. So if you have $1,000 on your account and you're putting $1,000 on every single trade and you have one loss, you're blowing that whole account. Because if you have a 50% loss, it will require you to achieve 100% return to break even. And this is why risk management is so important. And this is when it comes back to, it's not a skill issue, it's a capital issue that most of us are dealing with when we are trying to become profitable traders. And the important thing is, because you can't control whether a trade wins, but you can control how much you are willing to lose. Let's use poker for example. So at the end of every hand, the game forces you to stop and the money is lost, right? But trading, on the other hand, doesn't stop unless you stop. It will continue to take money until you have nothing left. It will literally drain your whole account until you sell that order. That is it. There's no start, there's no finish until you do it. Based on the size of your account, you should never risk more than 0.5 to 1% of your account on a single trade. And I know this sounds small, but that's the point. So at 1%, you can lose 20 trades in a row and still have 80% of your account left. So I know a lot of people say 1 to 2%, but if you use this method, 20 trades in a row and you still have 80% of your account, rather than trying to over risk and over leverage, and then you blow the account from one trade, right? It's just not worth it. So for every trade you take, you should return at least 2 or 3 times what you risk. So if you're risking $100, you should be making $200 or $300. So this means even if you win only 40% of your trades, you still make money. Like, forget the 90% win rates. You don't need it. And with correct risk management on a small account, it is going to feel like you aren't getting anywhere. But just remember, whether you're trading a $100 account or a $100,000 account, the process and the risk management are the same. So if you can't manage $100, you have no business, and you will never be able to manage a $100,000 account. You don't need a high win rate to become profitable. You just need good risk management. And this is the issue that we come across, because everybody's chasing these high win rates thinking that that's what's going to make them profitable, but it's not. With a 1-to-1 R, you only need 50% win rate to become profitable. With a 1.5 to 1, you only need 40%. And with a 2 to 1, you only need 33%. So that means you can be wrong 67% of the time and still make money in the markets. It's just because we can't handle those losses that we can't accept this fact. And if you have a 3 to 1, you only need to be right 25% to make money. You can be wrong 75% of the time and still make money. That's not bad. So for every 10 trades, you can lose 7 of them and still make money. When it comes to risk management and drawdown is always going to feel worse than what it actually is. Drawdown in trading is normal and to be expected, right? You can't expect a trader never going to be in a better drawdown. It's normal. It is going to happen. But in that moment, it is going to feel like it is the end of the world. But this is the most important time when you need to stick to your risk management rules. When you are in drawdown, don't panic. Don't close trades early. Don't do anything differently. It's going to happen. And you just need to prepare for it with a risk management plan. So how do you manage drawdown? So once you hit 5% drawdown, review your journal. Look for patterns and losses. What's happening? What mistakes am I making? Where can I improve on? Why does this keep happening? Once you've hit 10%, reduce your position size down by 50%. So then that way you're minimizing the drawdown that you're in. Once you've hit 15% drawdown, stop trading and then fully system review. See what's going wrong. See what you're doing. Go back to the journal again. Reassess everything. But when you're in drawdown, never increase your size. Never try to increase your size to make that money back. You're just going to increase the drawdown because something is wrong with the system. Something needs to change. And this is the difference between a normal and a dangerous drawdown. Every strategy has drawdown periods. A 5 to 10% drawdown during a losing streak is very, very normal, right? It doesn't mean that your edge is broken. It just means variance is playing out. And the danger is when you respond emotionally, increasing size to make it back, taking trades outside of your rules and abandoning your system entirely. So this is when you start to get emotional. This is when you're looking at revenge trading, oversizing, over leveraging to make that money back. This is when you go full tilt and you blow that account very, very quickly. One of the loops that we get stuck in is risking too much per trade, and then we're revenge trading after a loss, and then we're averaging into losing positions, and then we don't have a daily loss limit, and then we're taking trades outside of our rules, and then we're moving stop losses further away because we can't accept a loss. So this cycle of emotional behavior when it comes to trading is what's causing you to lose big. It's not because you have a 45% win rate or a 50% win rate. It's because of these things here. This is what's causing you to lose. It's not this. It's this. This is a book by Nassim Taleb called The Black Swan. So this is focusing on not trying to predict what the markets will do and start building a system that survives when you are wrong, because it talks about the black swan. It talks about random events that happen, which is trading, right? Because trading is random and the wins and losses are all random as well. So you're not guaranteed to have 5 wins in a row, then 5 losses. It's going to be win, loss, 5 losses, 5 wins, whatever it might be. It's going to be completely random. This book is very good at highlighting that. And this is just a breakdown of how to master your risk management. So accept what you can control. So you can't control if a trade wins. You can only control how much you lose, and when it doesn't, build everything around that. It's not about how much you can make, but how much capital you can protect. You need to define your risk per trade. So 0.5 to 1% maximum. Define where you're wrong first. So when you're building a trade, you're not building a trade from your entry. You're building a trade from where your stop loss needs to go, your entry, and then your take profit, because managing risk is the first thing that you should be worrying about. Calculate position size every time. It's not a guess. Calculate how much you need to place on this trade, how much it's going to cost, how much you're risking, and then where your take profit needs to be. Aiming for a minimum of 2 to 1 or 3 to 1 risk to reward. So you want to be making double or triple what you're risking on a trade. Daily loss limit. Set your daily loss limit to 2 to 3% per day, for example. And once it's been hit, walk away. There's no point taking more trades. At this point, you're probably going to be already a little bit emotional. You also need to have a maximum per trade day limit. So limit yourself. I'm going to take 1 trade a day, or I might take 2 trades a day, or 3 trades a day, whatever it might be. There's no prizes for trying to take 50 trades or try to take every single trade that you see in the market. And never, ever, ever move your stop loss further away. Once you've set your stop loss, that is it. Do not touch it. Don't move it further away. That is it, because you've already defined where you are wrong first. You shouldn't be working at your stop loss after you've entered into the trade or moving it for that fact. And then write it all down. A plan in your head is not a plan. Write every single rule, read it before every single session. Your rules were made with a clear head. Follow them when your emotions run high. This is why it's good to pre-plan things before you enter, because you can approach the market with a clear and calm mindset rather than an erratic emotional mindset. And now let's move over to the final part, the strategy and the technical analysis. So when I first started trading, I was focusing on the wrong things, right? So for the first 2 years, I was trying to perfect my strategy. I was thinking that this was what was going to save me from losing money. So I would add more indicators, I would watch more videos, I would have, 4 different systems all blended into one. And I was so confused that I didn't know what to do. And one strategy told me to do this, and then the other one told me to do something differently. And then it got to the point when I couldn't even trade. I couldn't even enter. And this is sort of some hard truths, right? This is some hard truths that you need to accept as a trader. And one of them is that a strategy alone isn't going to make you profitable. All a strategy does is allow you to manage risk. It doesn't predict the future, and every single strategy will lose and have losing streaks. That's just it, because no strategy gives you any certainties and it can't predict the future. All it does is allow you to manage risk. And contrary to the belief, every strategy can become profitable, and they do work. The only reason that it isn't working is because you aren't able to implement that strategy correctly. Then you need to find a strategy. Once you've found that strategy, you need to define your setup. So for me, for example, I draw support and resistance zones on the daily and 4-hour chart at a place where price has had a solid bounce before. Once price returns to the zone, I check to see which direction the trend is in. I don't just blindly long support or short resistance. If the trend is up, I will wait for price to return to the support zone. If price is trending down, I will look for shorts at resistance. The reason I wait for these levels is it allows me to manage risk and place my stop loss logically where the trade idea is invalid. So that is my setup, and that is my strategy defined. So the next thing you need to do is define your risk. So 0.5 to 1% per trade. Have your daily loss limit, the maximum trades, and your risk to reward that you're going to take as a part of your risk. The next important thing is you need to have a pre-trade checklist. So what direction is the trend? Is price where I want it to be? Can I achieve a 2-to-1 or 3-to-1 RR? Have I defined my risk and mindset check? So you need to be able to tick all of these things off. If price isn't where you want it to be to enter, you're not taking that trade. So the next thing is entering the trade. So if you followed your rules and manage risk, you have done everything you can, and the only thing to do is to let the trade play out and not interfere, because watching the trade won't make it give you the outcome you want. It's just going to make you more emotional and make you want to interfere, because again, it is so important, because trading needs to be viewed in large sample sizes. You can't determine if the strategy works after one win or loss. You need to collect as much data as possible. Aim for batches of 50 to 100 trades, and then reassess and see whether or not that strategy is profitable. And this book here, so Mark Douglas, Trading in the Zone, probably one of the best trading books that's out there to help you visualize mentally what it means to trade and accept probabilities and work on this system. So how do we put this all together to build an edge, which is the most important thing? So how do we build an edge? How do we move forward as a trader? These are the steps. So first off, you need to learn raw price action. So this is candles, wick, momentum, consolidation. Just understand which way the market's going. Look at the candle closes, look at consolidation, look at rejection where price gets to a level and the buyers push the price up and you get the long wicks and all of that stuff first. Then look at understanding market structure. So look at higher highs and higher lows. Identify the uptrends. Same with the lower highs and the lower lows. Identify the downtrends. Identify the market shifts where price is broken above and changed direction. It's broken above the last lower high and it's now made a higher high. Also understand time frame analysis. So starting from the weekly, moving down to the daily, to the 4-hour, to the 1-hour. So this is what's called a top-down analysis. So if you are trading on the lower time frames and you feel like you're getting stopped out all the time and you're not sure which way the market's going, align your time frame on the 15-minute with the 4-hour or the daily. So if the daily's in an uptrend, wait for the 15 or the 5-minute to get back in line with the higher time frames and trade with the trend. And once you've understood this, pick one strategy. Find the strategy that best suits you. If you feel like some strategies are really complicated and you can't understand what they're saying, look for a strategy that you can understand. You don't need to trade what everybody's trading at the moment. It's just about finding something that works specifically for you. That's why there's so many different strategies. They all work. Different people are able to understand them differently. Once you've done all of this, define your setup. So write down your exact rules to follow every single time, because no one's there to make sure you're doing exactly what you need to be doing as a trader. The only person who can make you do what you need to do is you. Follow a set of rules, have it stuck to the computer. Make sure you check off those rules before you enter into a trade. If you can't tick everything off, then don't take the trade. After you've built your system, you're going to start building your risk management. So you're going to build your risk rules, which is, that 0.5 to 1% per trade, that 2-to-1 or 3-to-1 RR, setting your daily loss limit and then your max daily trades and sticking by it. This stuff is so important because if you don't stick by it, no one's going to hold you accountable. You need to be the one to hold yourself accountable. Building your risk pre-trade checklist. 5 questions, all yes or no. It removes emotions from entries. If you can't say yes to every question, don't take the trade. Just move on. You don't need to take every trade that's in the market. And this is when it comes to building that psychology side. Take 50 to 100 trades. This is the only way to see if the system is working for you. You can't see if a system works after a couple of trades and say this strategy is no good. You need to collect enough data to see if it works. Also journal everything. Every single trade, how you feel before, during, and after. You can't collect data if you're not journaling. You can't see how you're reacting if you don't journal it. You might look back and go, I'm actually really bad at revenge trading, but you can't pick that up if you're not journaling, because when you're in a calm mind and you go back and look over it, you can sort of sit back and say, oh, I'm actually really, really bad at revenge trading or FOMO or analysis paralysis, whatever it might be. And then after you've done this, review the data. What is working and what isn't working? What mistakes am I making? What do I keep repeating over and over again? Refine your rules. So make changes based on data, not emotions. This is why it's important to collect those large batches of trades and journal everything so you can see what you need to change. And all you have to do after that is repeat the loop. Every 50 to 100 trades, reassess, go again, make tweaks, improve, because it doesn't matter if it's $100 or $100,000, process does not change. Just keep doing what works, refine what isn't, and keep moving forward. It's all about 1% better every day. You don't need to be a perfect trader day one. There's no rush. It's you versus you. You need to find the strategy and style that works for you and your lifestyle. If you are working full time and can't be at the computer, look at swing trading, for example. Or if you feel like the 5-minute and the 15-minute chart are too hectic, you don't have to trade on those time frames. And this is why there are so many different styles of trading, because everybody's different, and what might not work for you might work for someone else. It's all about finding what suits you the best and just repeating that. You don't need anything fancy. You just need what works for you, because at the end of the day, you are the edge. The strategy isn't the edge. The strategy isn't going to get you profitable. You are going to get you profitable by following all of these things and implementing it together and building a system that works long term for you. But if you want a copy of this, I have dropped a link in the description so you can download it. We also have the free Discord where we go over everything like this. Every Sunday we do trade analysis and we do breakdowns. And I've also linked my free trading support and resistance mindset book in the description as well. But thank you guys for watching, and I will see you on the next one.